Going once, going twice. Sold.
Um, Now, something that's not unpredictable, something we can certainly research and we need to know is tax lien roll-up. And the main point to remember here is, if a tax lien doesn't redeem, so in other words, if the property owner doesn't pay off the taxes, then foreclosing on the property is the only option that you're going to have to get your money back. And one of the requirements that the county is going to have is, in order to foreclose, there can't be other liens that exist, because liens, again, prevent foreclosure. So you can't have other liens that exist against the property and have the ability to foreclose on it. You're going to have to pay those liens up in order to foreclose, and that's what we call tax lien roll-up. It's any other taxes that need to be paid off in order to foreclose on the property, in addition to the lien, that you're buying. So it's basically looking at the total foreclosure cost on the lien.
Yeah, exactly. And when it comes to tax lien roll up, it can also kind of depend on the state. For example, there's going to be some states that you're not going to have a huge amount of roll up. Maybe a state like Maryland, where you can, it's 2-year redemption period, but you can start the foreclosure after 6 months. We'll still look into any of the back taxes because it's something we want to know. But in a state like South Carolina, they only have a 1-year redemption period, and then they issue a deed. So you're not going to have roll up in that. But there is a lot of states out there where roll up can play a big part. Florida being an example. And so they're going to have a certain amount, usually between 5 to 7 years worth of tax liens that can still remain on the property. So let's say that you found a tax lien, and this is something that happens sometimes in Florida, is you'll see a tax lien. Oh, that's not too bad. Let's say it's a $500 tax lien on a $10,000 lot. Well, if you were to look into the property more, let's say it was, from 2023, for example, or 2025, well, there could be 7 other years worth of tax liens, or a total of 6, still on that property. So there could be a $700 lien, a $900 lien, $1,100 lien. In this case, you've got $8,100 worth of roll up that you're going to have to pay to do the foreclosure. So when you go to foreclose on the property, you have to pay off all those other tax liens. So essentially, you own all the debt on the property. That's what gives you the right to foreclose on it. And so in this case, you're going to have all of this extra payment that you're going to have to pay out to try to foreclose on the property. And these are what we call toxic tax liens, where there's so much owed that it doesn't make any sense to go ahead and purchase the investment.
Yeah, when it comes to tax lien states where roll-up is a concern, a couple of things are a factor. The duration of the redemption period. So the longer the redemption period is, the higher your chances of having roll-up issues, are going to become. So these states that, if you have a 3 or a 4-year redemption period, like certain states do, like Arizona or Colorado, or there's quite a few other states beyond that, but those are states where you can have roll up where it can become an issue, where you can, it can add up and can certainly change the numbers on certain deals. So again, it's really about where you're investing and just making sure that you know what you're investing in. If you're investing in it's a 1st-year lien, then you're totally safe. You don't have to worry about it. But if you're looking into a property, that's why we look at the tax history, so we can see and get an accurate idea of just how many other liens exist against the property, so that we know, oh, okay, this isn't a 1st-year lien. This is actually the 5th year of of lien here. So there's all these other liens that already exist. That's the kind of thing we want to know before we buy.